If you're considering making an additional super contribution, it is vital that you understand the tax implications of this. If you don't, I've seen the situations before where people have made large super contributions, but because they didn't understand it or they didn't follow the right paperwork, they haven't been able to claim these as a tax deduction and haven't been able to release these funds from their super fund. Today, I'm going to be going through everything you need to know when it comes to tax on super contributions. Today, I'm going to be covering 3 different types of contributions. We have concessional contributions and non-concessional contributions, and then I'll be touching on the government co-contribution. Concessional and non-concessional contributions have very different tax implications, both inside of super and outside of super. So it's really important that you understand the vital differences between the two. Now, before I go through these, I just want you to know that super is a very individualized thing. You really need to understand your own situation because different funds will have different rules. There's different rules depending on your balance of your fund, on your age. So you really need to seek your own advice in this area before you go and make any contributions. So let's start with concessional contributions. And the easiest way to look at these are the ones that are going to be a tax deduction. Concessional contributions will typically happen in 2 ways. They'll either be paid before you get taxed. So this is like your general super contributions that your employer makes. These are actually concessional contributions. In essence, they're actually reducing your taxable income because you never receive these. You don't have an option, but they get paid straight to your super fund. They're coming from your pre-tax money. We then have ones that we pay out of our own pocket after we've been paid our wage. We might go, we want to make an additional contribution. So these ones are paid out of post-tax funds, and these are the ones that we can claim as a tax deduction on our tax return. And this is because these contributions will be taxed in the super fund. So when they go into the super fund, they're taxed at 15%, but we can claim them as a tax deduction in our personal tax return. And this will reduce our personal tax return by whatever our marginal tax rate is. So you can see the marginal tax rates vary here, and obviously the more you're earning, the more impact making a concessional contribution will have on your total tax payable. What is really vital when making a concessional contribution and wanting to claim it on your tax return is that you need to fill out what they call a notice of intent to claim. And this is a really important form because if you don't fill this out, you can't claim the contribution. And I have seen this happen before where people have forgot to fill out the form and they've either rolled funds into another fund or they've missed the due dates and therefore they weren't able to claim that super contribution as a tax deduction. And it really hurts those people, especially if the sole reason for making the contribution in the first place was to get a larger tax deduction. So if we have a look here, we need to lodge the notice of intent to claim form by either the day you lodge your tax return for the year in which the contributions were made or the last day of the income tax year after the income year in which you made the contributions. Now we need to get an acknowledgement back from our super fund because the form is sent to them. They acknowledge that they have processed it correctly on their end and therefore these are what are available to be lodged in your tax return. So what I normally suggest to people is lodge this as soon as you know you're going to be claiming that as a tax deduction. Get that form lodged. You can always lodge an amendment if something changes in the future, but you want to make sure you've got your paperwork in line so that you can actually capitalize on this contribution in the way you intended. One other thing is you want to make sure you speak to your super fund, especially as we get close to the end of financial year, about what their cutoff times are for them to receive your money. They need to have received your contribution for you to be able to claim it in that income tax year. So if you're wanting to make a contribution for a particular year, make sure it's going to reach your fund in time. Now we do have caps on how much we can put in as concessional contributions. So the cap currently is $27,500. This does change quite often depending on inflation, etc. So keep your eye on that on the ATO website. Now the key thing to remember is that your employer contributions count towards this cap. So if you're already earning income, these are going to count. So if you're going to make an additional, you need to factor that in. Now they did bring in a few years ago that we could have carried forward contribution caps. So what this was in essence is that if you haven't used up all of your super contributions from the last 5 years, we can then roll them forward into this year and make a larger contribution. So for instance, in a future year, if the cap had been $27,500 each year, but we'd only been putting $17,500 in each year, this could give us up to $50,000 of rolled forward contributions that we could use. So you need to understand this if you're looking to make a large contribution. You want to know, have I got ability to roll forward anything from previous years? Now, as I said, this can only be done for a 5-year period and your balance of your fund has to be under $500,000. Now let's look at non-concessional contributions. And non-concessional contributions are the ones that are not tax deductible. So these are paid from your after-tax funds. So after your employer, for instance, has paid out your money to your bank account, you can make a non-concessional contribution. And the key difference here is you're not going to be claiming this as a tax deduction. So this means it isn't going to reduce your personal taxable income, But it also means when these funds go into the super fund, they're not taxed. They don't have that 15% tax like the concessional contributions. Now there's a $110,000 cap on these per year, but these ones have what they call a bring forward arrangement. So this means that you can make up to 3 years worth of contributions in 1 year. So with the $110,000 cap, if you had a large sum that you wanted to put into super, you could put up to $330,000 in this year. Now, obviously this means that you've reached your cap then for the future years, but it is something to keep in mind if you've got large amounts of funds that you're looking to move into your super fund. Now, there are a bunch of rules here which I'll have a look at. So to meet that in the current financial year, you have to be under 75 years old for at least 1 day during the year, contribute more than the annual cap, which is the $110,000, are not already in an active bring forward period, and have a total super balance at the end of 30th of June of the previous financial year that is less than the general transfer balance, which is $1.7 million, or has a capacity greater than the annual non-concessional contributions cap. So you need to make sure you're not going to breach that general transfer balance cap. So that is a cap that's in place of currently $1.7 million that you can't contribute beyond that with non-concessional contributions. So it is something to keep in mind if you've got a larger super fund balance. These contributions might be less common at tax time because you're not rushing out to get that tax deduction, but they do have their role in some particular strategies. A lot of financial planners will potentially look at these strategies as people getting closer to retirement and wanting to move large amounts of funds into their super fund where maybe they might be taxed a little bit more effectively compared to in their personal returns. It is a bit of a complex area, so make sure you are seeking that personalized advice. Now, before I talk about the government co-contribution, if you haven't already subscribed to this channel, make sure you do that because I've got the goal of hitting 10,000 subscribers by the end of this year. We're not quite at 4,000 yet, so we've still got a long way to go, but I can do it. I know I can, and I'm going to keep putting out lots of quality content, especially over tax time, to help you get more out of your money. Anyway, let's get back into the video. Now, the government co-contribution is a contribution the government makes on your behalf if you meet the requirements. Now, this is an amount of up to $500 if you've contributed $1,000. Now, there are a variety of thresholds here, which I'll put this up on the screen to show all the different changes over the number of years. And there are a number of other requirements you must meet. These include have made one or more eligible personal super contributions to your super account during the financial year, pass the 2 income tests, so there's that income threshold, plus a 10% eligible income test, be less than 71 years old at the end of the financial year, not hold a temporary visa at all during the year, lodge your tax return for the relevant financial year, have a total superannuation balance less than the general transfer balance cap, and have not contributed more than your non-concessional contributions cap. So if you're going to make these contributions and looking to get the government co-contribution, it's really important that you understand these requirements. It's really vital that you understand the differences between concessional and non-concessional contributions, especially if you're looking to get that tax deduction in before the end of the financial year. You want to make sure that your paperwork is in line so that the amounts you're putting into your super fund with the intention of claiming are actually able to be claimed. If you're looking for other ways that people look to reduce their tax, and in particular the rich and powerful, this upcoming video I talk about the secrets that the rich and powerful use to get more out of their money in the realm of taxes. I hope to see you over there.